So far, we have discussed about functions of central bank as currency authority or bank of issue, banker to the government, bankers, bank and supervisor. Now it's time to talk about how does the RBI become the controller of money supply and credit. Under this category, we will be speaking about two categories. One is the quantitative measures, the other one is the qualitative measures. Under quantitative measures, we will be speaking in detail about bank rate. We'll be talking about repo rate, reverse repo rate, open market operations, and legal reserve ratio. Under legal reserve ratio, we'll be bifurcating into two things. We'll be speaking about cash reserve ratio and statutory liquidity ratio. Under qualitative measures, we'll be talking about margin requirements, moral suasion, and selective credit control. Before we understand the tools of each of these tools, what we must remember is that demand for currency and the rate of interest are inversely related. If rate of interest is increased, demand for credit will go down as cost of borrowing will increase. And the second situation is if rate of interest goes down, the demand for currency will go up or credit will go up as cost of borrowing will decrease. So here there will be more money supply in the economy, and here there will be less of money supply in the economy. So now it is easy to understand definitely what has to be done when you want to increase the money supply in the economy and when we want to reduce the money supply in the economy. So the first tool which we are trying to understand is the repo rate. What is repo rate? We know the banking structure now for the country. You have the central bank, and below the central bank you have number of commercial banks, and below the commercial banks you have the public. So we as people are not dealing with the central bank, we are dealing with the commercial bank. But whatever central bank does in terms of increasing the rate of interest or reducing the rate of interest is going to have an impact on the total amount of credit creation in the economy. So now we start with explanation of the term repo rate. Repo rate is the rate at which the central bank lends money to the commercial bank. Central bank is lending money to commercial bank. What is important in this definition is this money is being lent by the central bank to commercial banks to meet their short term needs. So the interest rate which is charged will be for the short term. Now you have to know case 1 and case 2 situation. When the repo rate is increased, this will be the first thing. The cost of borrowing will increase. If cost of borrowing increases, then the total amount of credit which the people will take will reduce. So credit creation will be reduced in the economy. The second situation is when the repo rate is decreased. If repo rate is decreased, meaning that the rate at which central bank is lending to the commercial bank has gone down, so commercial banks will also reduce the lending rates. If commercial bank reduces the lending rates, then the demand for money will go up because the cost of borrowing has become less, and consequently there will be more money supply which will be pumped in the economy. So accordingly the RBI can use this tool whether it wants to increase the amount of money supply or reduce the amount of money supply. The next tool in the hands of RBI is the reverse repo rate. In case of repo rate, it is the central bank and lending money to the commercial banks. But in case of repo rate, it is opposite. It is the rate of interest at which the commercial bank will deposit their surplus funds with the central bank. Other part remains the same. It is for shorter period of time. So if the reverse repo rate is high, it is more profitable for the commercial banks to park their surplus fund with the central banks, so there will be less amount of money with the commercial banks. If less amount of money is there with the commercial banks, because much of it they're parked with the central banks because of high rate of interest, so less will be available for the public, so less amount of credit creation will take place. Second situation is when the central bank reduces the interest rate on the surplus funds being parked by the commercial bank. It is more profitable for the commercial banks to use their surplus funds to lend to the public. If they use their surplus funds to lend to their public, there will be more amount of credit creation in the economy, so more amount of money will be pumped in the economy. So only difference between repo rate and reverse repo rate is the direction in which the funds are moving. In case of repo rate, it is the central bank lending money to the commercial bank. In case of reverse repo rate, it is the surplus fund of the commercial banks being parked with the central bank according to the rate of interest. If rate of interest is high, the commercial banks would prefer to park the surplus funds with the central bank. However, if the rate of interest is low, it will be the opposite. The third tool in the hands of RBI to control the supply of money and credit is bank rate. Bank rate is similar to repo rate. The only difference is here the money is being lent to meet long-term needs. So the remaining definition continues to be the same. It is the rate at which central bank of the country lends money to the commercial banks to meet their long-term needs. So again here you need to know case 1 and case 2, how to explain it. Now if the bank rate is increased by the central bank, so commercial banks will also have to increase the rate of lending, so cost of borrowing will go up. If cost of borrowing goes up, then less of credit creation will take place because it's not profitable for the people to borrow funds from the commercial bank. Case 2 is when bank rate decreases. So when bank rate is decreased by the central bank, commercial banks will also do the same. So cost of borrowing will become less. If cost of borrowing becomes less, it is more profitable for people to take loans from the commercial banks. So more credit creation will take place. The next tool in the hands of RBI to control the amount of money supply in the economy is called as open market operations. Now, open market operation in simple terms means buying and selling of government securities by the central bank from or to the public and commercial banks. So first we must understand how this buying and selling affects the total amount of credit created in the economy. So we'll again study this under two headings: sale of securities by the central bank to the commercial banks, and second case we will study is purchase of securities by the central bank from the commercial banks. So two things in this respect you should remember: when you buy something, you have to pay, so the amount of money will become less, and when you sell something, you receive what? Receive money, and the amount of money with you will become more. So we understand case 1. In case 1, the central bank is selling securities to the commercial banks. So if commercial bank is receiving something from the central bank, that means it's buying the securities. If it has to pay the central bank in return, so the amount of money with the commercial banks will go down, it will become less, so the total amount of money created or credit creation will become less. This is how we explain the sale of securities by the central bank to the commercial bank. You can make a flow chart and remember this concept. And basically you have to understand, when you sell, you pay. When you sell, this.